Recapping our top story, the Fed says so long 75 and Wall Street says hello rally. The S&P jumped 3%, its best one-day gain since May of 2020. The Dow surged more than 900 points, its best day since November 2020. And the Nasdaq roared higher by 3.2%. But our next guest isn't cheering the Fed's moves today. He says the chair is too optimistic and thinks Powell is just winging it. Peter Boockvar is the Chief Investment Officer at Bleakley Advisory Group and a CNBC contributor. Peter, great to have you with us. I'm getting a lot of tweets, not that I care what Twitter says necessarily, but that we're so negative. So I guess, welcome to the party here. Why do you think Powell is just winging it? I mean, in reality, isn't that what he should do? Because we don't really know what will unfold. So there is going to be a certain degree of, quote unquote, winging it.
Oh, I agree. I mean, they're going to raise rates. They're going to shrink the balance sheet and see what happens. Part of the winging it was he was asked the question, why aren't you starting QT now instead of waiting until June 1st? And he said, well, we just decided to pick that day. Like there was no science behind that. Then he was asked, well, what's going to be the impact of QT? Well, we just really don't know. Well, if you don't know the impact of QT, then why did we have QE? How would you know the impact of that? So there's a lot of just, throw stuff against the wall and see what happens. And I think they did that on the easing side, and they're going to do that on the tightening side.
Hey, Peter, it's BK. So, he talked a little bit about the path to a soft-ish landing. Where do you stand on that? Because it seems to me that that's a pretty narrow needle that he needs to thread.
Well, this is going to be the most aggressive tightening cycle in 40-plus years between the rate hikes and the shrinking of the balance sheet. And considering how dependent economic activity is to cheap money, how dependent markets have been to cheap money, I don't see how it's possible to achieve a soft landing.
Peter, it's Karen. I think this is a question I asked you maybe last time you were on. If you were magically the Fed chair today, what would your policy be?
Well, I would do what he's doing now. The difference between myself and Jay Powell is prior to this in the terms of the amount of easing and for how long they did it. But I think he's on the path that he should be, and then we just get to see what happens. We all debate about what's priced into the markets, what's not. What's not priced in, I believe, yet in full, is the economic impact of all this. The bond market's priced in pretty much all the rate hikes we're going to get and then some. But I haven't seen earnings estimates for this year change at all, and if in fact they've gone up. So if they're low odds of a soft landing, which means that we're going to have a recession, well, that means that earnings numbers are going to have to come down. And the economic impact of not just what the Fed does, but what the ECB is going to do, the BOE, the Bank of Canada, a global synchronized monetary tightening, I don't think the economic impact of all this has been fully priced into markets.
Peter, we were just talking about, the notion that Powell has control over the demand side and not the supply side. And we're seeing commodities go to these levels, even with China's most populous cities effectively locked down in some way, shape or form. How do you see this playing out? I mean, let's say by, fall or the end of the year, where do you think we are in terms of the impact on the consumer here in the U.S. and what we're seeing in terms of inflationary pressures? Do you think he gets at least some of the inflation out of the system?
Well, I do believe that the rate of change in inflation has peaked out here. And it's just a question of how much do we fall. But there's a lot of price increases in the pipeline. I'll listen to a lot of conference calls, and companies are still going to take this year and into next year to recapture lost profit margin. And then it gets to the question is, at what point does the consumer blink in the face of these rising prices? And on the low-end consumer, they're already beginning to blink. And whether Etsy's a tip-off, where I've seen some others. The question is when do we get to see that breakage in other parts of the income strata, call it? And I think we're getting close to that point. And that's when the consumer starts to say, you know what, I'm just going to wait. I don't need to do this right now. I'm just going to wait to see if things cool down in terms of pricing. And I think we're now running up to that line that we're about to cross over, which then has obvious economic implications. And then you start to see an eventual decline in inflation. But it's the inflation that eventually breaks the inflation.
Right. Peter, always great to get your take. Thank you. Peter Boockvar, in Peter's note earlier today, before the Fed decision came out, he made the point of, the U.S. consumer being so used to discounts. Remember, once upon a time, everybody waited till like November, even past Black Friday, till like a week before Christmas to do all their shopping because prices would come down. And here we are in the situation where it's assumed that consumers are going to pay up price increases after price increase on toilet paper, on dog food, on Pampers.
On gas, on food. I mean, the list goes on and on. And listen, I think one of the most important things Peter said, and he does really thoughtful work, and he does listen to dozens and dozens of earnings calls. And I think that's where you get a lot of the good stuff. Earnings estimates have not come down for the S&P 500. We had GDP in Q1 that contracted, okay? We have all of these inflationary pressures. Even if they come out, even if it peaked in March, they're still staying high. So you're telling me that S&P earnings are going to be up 8, 9, 10% possibly? No way. I mean, I suspect they come in mid-single digits, maybe low single digits, and that's why the S&P 500 has not bottomed out. The high valuation stuff, we're seeing that compression right now in stuff that's down 50, 60, 70%. We have not seen it in the mega cap tech names, and I think that's the next shoe to drop this summer.
So one of the things that we've debated on the show is the Fed's willingness for there to be price destruction or income destruction, wealth destruction within public markets and private markets. One thing that I think is flying under the radar is destruction within the housing sector and how that ties to the consumer. I don't think you really are able to tighten down spending in a way when people are still able to access additional credit in their homes. Now, those rates have continued to rise, but I think that's another shoe to drop that I'd be very interested to see how the Fed is going to handle that.
Yeah. The desk is decidedly negative tonight. I mentioned that.
Karen's probably positive.
Always positive.
I wouldn't say I'm all that negative. I'm skeptical of this 900-point rally that Powell took 75 basis points off the table. This market can rally. If the equity investors want to decide that he was dovish, this thing can rally. Earnings estimates haven't come down. It can go for it. I'm just going to
believe it.
I might not believe it, but I'll trade it.
Yeah.
Well, thanks, Little Miss Sunshine. I had a couple things, actually, that I thought were positive. Actually, in the housing front, there were two companies that reported today. Residio, which is a spin-off from Honeywell, and another one, BXC, which is, I think, BlueLinx. It's also in the housing-related business. Both giant earnings and big forecasts. And why would you need to put out a big forecast in this market? They must feel very confident. The other thing is the S&P, we always talk about this all the time, it's not a monolithic one stock thing. You've had the IGV kind of names, the super high-tech software ones get crushed and probably have more room down. And then you have some things like a CVS today at 11 times earnings. There's a lot of value.
But it is kind of monolithic because there's like 5 names that make up 25% of the weight of an index of 500 stocks. In the NASDAQ 100, those 5 names make up about 45%. So it is monolithic. And I actually think, I've said this before, I think the Fed buys Apple all the time. Apple was trading up 1% today. It really was, keeping the S&P and the NASDAQ not looking nasty when I looked at dozens of stocks that were down 5, 7, 10% or so. So I think there's some funny business going on there. It is a monolith.
I think there's a plunge protection team.
I do. I think that's the easiest traded. Why? Berkshire Hathaway is all Apple. Why couldn't the Fed's balance sheet be Apple?